So guys, I want to talk a little bit about mortgage insurance and the concept, but also what mortgage insurance is and how you can utilize it in the next mortgage. So the key word, and we've already been through this in our last episodes, is the concept of risk, right? So most people understand that piece now. In other words, most people understand that a lender is going to lend you money based on the overall risk profile of this loan. Now, whenever you put less than 20% down, you're going to have to pay some form of mortgage insurance, okay? In other words, whenever you commit less than 20% down on the mortgage, you're going to pay a factor per month to mitigate the risk of the exposure for the lender. So it's similar to this example that I always give to a lot of my friends and first-time home buyers. If we were close friends and you came up to me and said, hey, I want to borrow some money to buy this motorcycle, the two questions that I would ask, or any lender would ask, is this. Number one, when am I going to get my money back? And number two, how much of this bike am I buying, right? So if I say, well, you're lending me 50%, I'm bringing the other 50, your risk is very low. Therefore, your terms are going to follow. But the moment I say, hey, you're going to lend me 90% of this loan, the risk starts to go up, right? In the same way, a lender is going to measure the overall risk profile of your loan by looking at capacity, collateral, credit, character, cash. They're going to look at the amount of money you're putting down, and they're going to determine whether or not you're going to need mortgage insurance. So mortgage insurance at its core, it's simply just a way for a lender to mitigate the risk of their exposure. And it's a factor that you're going to pay per month until your loan to value ratio, so put it up here, LTV, right? That's the acronym, reaches a certain threshold. The loan to value ratio threshold is 78% by law. So at 78%, in other words, when you either pay down your mortgage to reach that level or your property appreciates in value, at 78% by law, the mortgage insurance will go away. At 80% loan to value, right, LTV, you can request the mortgage insurance to go away. In both of those cases, the servicer is going to do what's typically known as an appraisal on the house to make sure you're within those thresholds, right? So mortgage insurance at its core, it's literally for a lender, it's a way for a lender to mitigate the risk of their exposure. Now, interesting fact, actually a lot of people don't even know this. Actually, most mortgage bankers don't know this. Mortgage insurance actually prices out in multiples of 5. So 5, 10, 15, 20, right? At 20%, you obviously don't have any. Now, why is that so important? It's important because some people come to me and say, hey, Leo, I just want to commit, 13% down. Can I see the difference in the actual mortgage insurance per month versus 10? And what I often say to them is this: if you want to see a difference in your payments per month, either commit to 15, in other words, commit 15% down, or reduce your down payment amount. In other words, it won't make a difference if you put 13% or 10%. The factor is going to be the same. It won't make a difference if you put 17% or 15%. The factor will be the same. So mortgage insurance is a way for a lender to mitigate the risk of their exposure. And it's literally a factor that you're going to pay per month until you reach those specific thresholds. I hope that's helpful to you. Hey guys, thank you so much for tuning in. If you are a buyer, first time, second time, a person that's looking to refinance, or even a real estate professional, financial advisor, or CPA, and you find this information valuable, please don't hesitate to subscribe and feel free to share this information with anyone that you think might benefit from it. Thank you again for tuning in. Talk to you soon.